Hey everyone, hopefully you're having a good day. My name's Andy, the channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in and take a look, see what's going on today. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deeper into all these topic subjects, sectors, looking for investment opportunities, sharing those opportunities with everyone in the community. I do that through midweek updates where I go through individual companies and setups. And then I also do that for Q&A sessions on the weekend, either Saturday or Sunday. We do have a special coupon code. It is special, 50% off the first month only on the monthly membership and a $100 discount on the yearly membership if you're interested in swapping from a monthly to a yearly or going directly into it. All right, so if you're wondering where we're at in the oil cycle, just look at Saudi Aramco. It's trading at the same levels as during the pandemic, when we thought we'd never open up and never fly again. So that's a double bottom is what I'm seeing here. So we came on up with a good surge, and then we came back down on these small little red candlesticks. You can also see we've got one. This is an Elliott wave correction. So you get a top, shoulder, head, shoulder. We pull back. This is a bottom, an Elliott wave here, and then it comes through and does another correction. This is a three wave down move coming down like this. And we usually come right back to the bottom. To me, that looks like it's about done. So this actually doesn't look like a bad entry for Saudi Arabian oil or Saudi Aramco. But again, I'm not entering this. I'm in stuff that can grow production that looks a lot better from a production standpoint. Saudi, I don't think they're going to grow production much. Yeah, I'm sure they're the most profitable company, but they won't be the highest growth company. Growth is what moves your share price. It's money flows coming into the stock, and then ultimately what drives the business is per share growth. So if you've got production per share growth, earnings per share growth, all of those things. So Saudi, I don't think is going to beat a lot of the other companies that I'm in on a production per share growth basis. And that's all that matters. Coming down, we got the Sprout Physical Uranium Trust. Where would your uranium equities trade when spot U308 trades at new highs? Well, it's going to be a lot higher, would be my guess. And we've broken out of that 15-year base. So we had a breakout, a retest, and now we're moving off that retest base. It's a great opportunity to be looking. Now, would I be out there buying a bunch of uranium? Probably not. I mean, a lot of them have gone up. They're making new highs. They're not exactly cheap on a price to book, price to earnings ratio or anything like that. Do I think they'll go up? Yeah, I do think they'll go up because of this. So I think we're in that big part of the cycle that we just started it. It started here at the bottom in 2025, and we are heading higher. So I think we're in the thick of a big move. Axel Kabar says, next big breakout can take place in copper and other industrial metals. I don't know what the macro driver can be, but charts are very close to breakout levels. No, they are breaking out here. He's got a price projection, at least on copper here, of 13,900 from 10,550. This is a double bottom, a breakout, a retest, and now we're moving higher. And notice copper is trading very similar to uranium. We've got the base, the breakout, the base, the breakout, and then the retest, the retest. Very similar in how these things trade. They're not exactly the same, but very similar. And then you can see these charts. You can see the same charts here across everything. in commodities. They're almost all the same. Steel, iron ore, zinc, there's a whole bunch. They're all very similar. Thesis says every lithium stock just woke up from a 3-year coma. In 2024, the lithium market was swimming in 154,000 ton surplus. Next year, you're looking at the first deficit in 4 years. More than half of all new passenger cars sold in China were fully electric or plug-in hybrids. Right now, we're seeing what the US government saw 3 weeks ago. America needs lithium. The US government doesn't buy equity stakes in sectors that are dying. They buy them in sectors they know are critical, strategic, and in demand. Intel and MP were the start of it. So here's the lithium flip from glut to deficit. 2024, 2025, 2026, 2030, and 2035. Huge deficit in lithium coming. On the website, we have positioned for this exactly. We bought the bottom of the lithium market to the T. We did a pretty good job there, and I think we've got the best companies that the sector has to offer. Period, bar none. We're in them. Some of them, one of them recently went up well over 200% in like a month. I'm sure you know which one that is if you know which one it is, because it went up vertical here with the government taking a stake in it. Final crude estimate for October 3rd week. Looks like he's projecting a surplus of 5 million barrels per day, or 5 million barrels, sorry, just surplus, period. And there is the US commercial crude storage. We are on the low end, but there's a lot of people expecting this to build towards the end of 2025. And I agree. I think we could build. 2025 has a couple of projects coming online throughout the world. And then after that, it's pretty bare. So yes, we could get a little bit more oil flow going throughout the world. OPEC is bringing more barrels back. And then we'll see what happens in 2026. I think things will squeeze up. Now, the markets, a lot of people, they're looking at this data. Everyone knows this data. I know the data. Everyone who's smart that looks at the oil market knows the data. We all know this data. We know projects are coming online in 2025. We know OPEC is bringing oil to the market. Why isn't oil crashing? I think we all know, not with certainty, but we all think that something after 2025 occurring in 2026, we're looking out there saying, where's the oil going to come from? And everybody's like looking at each other like, where's the oil coming from? And we're all looking. So now all the investors are kind of looking at each other like, are you going to buy? Am I going to buy? Are we all going to start entering the equities? Because we kind of know that there's nothing out there. So do we buy now? Do we wait? A lot of people say, oh, oil price is going to go down. It's like, that's not what the charts are saying. The charts all have bottoming patterns that have bottomed and are turning higher in energy service and oil. So a lot of people, I think they get confused. They get confused because the market's like, well, we're going to get more oil in 2025. And you look at the equities and you're like, well, they're not going down. Why? A lot of people get confused around that. It's because investors are looking beyond 2025 into 2026, 2027 and saying, where's the oil? And I'm sitting in it. I am directly invested in oil and bought that bottom in April, May of 2025, waiting for this. Now, I don't care what the short term does. It doesn't matter to me because I look out there and I'm like, where are you going to get this oil, guys? Now, each year that passes, decline rates are about 10, 11 million barrels per year in decline. Where are we going to find 10 or 11 million barrels per day, per year? every single year. Are we going to find that and hold steady? We've got demand growing and supply. I'm just like, I don't see it. When we get out a couple of years, let's say 2028, 2029, I find it hard to see where a whole bunch of oil is going to come from. And we need to add about, because that's 3, 4 years out, we need to add 40 million barrels of new oil to stay flat. Where's it all going to come from? I don't know. I don't know. So short term, I can understand some of the pessimistic kind of outlook. And then I look past that and I'm like, I don't know. I think everything's going to squeeze up. Late 2020s is when things are going to get real dicey in the oil markets, and natural gas markets is going to be here probably next year or two. Things are all going to get dicey as heck. I don't think we have enough natural gas to feed LNG that's coming online in all the way up to 2030. I don't think we got it, which then is going to pressure the entire system. The entire system is going to be under pressure from like 2026 onward of oil, nat gas, coal. Uranium is going to get a bid too because we want a lot more energy, and that's going to have to fill some of it. A lot of people are talking about solar. I don't see solar being a threat because, I mean, just wait until the currency has issues and everybody starts running at silver. Silver price is going to go up ballistically, and I think that could impact solar as well. So I think we're just going to go late 2020s. We're going to squeeze a whole bunch of crap. I mean, it's going to be. You're not. I don't even know if the world's going to look similar to what we have today. Late 2020s. Copper is going to squeeze. A whole bunch of base metals are going to squeeze. Aluminum is going to squeeze. Iron ore could. I think we could see coal squeeze. Natural gas will squeeze. Oil will squeeze. I mean, everything. And I'm curious to see what interest rates do and how currencies handle all that. I don't think it's going to handle it for crap, which then means that silver is going to squeeze, gold's going to squeeze, palladium's going to squeeze, platinum's going to squeeze. Like everything will squeeze out late 2020s. Everything. It's going to be ridiculous. The bull market in commodity nations is just beginning, and that's the squeeze. It's all beginning now because people are looking forward and seeing the same thing that I'm looking at. I'm going, man, this is going to get tight in many, many markets. And then the countries that sell all those commodities, they're going to make a bunch of money on it. That's what they're going to do. So this is the countries: Australia, Brazil, Canada, Chile, Indonesia, Norway, Peru, Saudi Arabia, South Africa, and UAE, which we have a lot of companies in these areas. And they are multi-year high. We're about to break it here. This is your base. Now, I know some people, we've seen it from here going up. We've got a huge gains in some of our companies here. Huge. And we're just starting to break out of this bottoming pattern. The big move is still coming, guys. It's still ahead of us. It's not behind us. And the thing is, it's difficult to see today because everyone is making projections about tomorrow. And tomorrow is what we are positioning for. We're not positioning for today. We're positioning for tomorrow. And this here on the charts is signaling that positioning breaking out. Commodities are the spot to be in these emerging markets. Gary says there are some physical precious metals shortages being reported in a few places around the world. The shortages we are seeing today are just a preview of a full-blown global supply crisis that is coming. Yeah, I could get behind that for sure. Now, this isn't going to be just precious metals. There's going to be stuff that gets tight all over the place, and the way that it's going to be solved is going to be higher prices. Now, the thing that scares me is when prices go way up, what are these broke, desperate countries going to do? They're going to try to tax the living crap out of them. They're going to try to get their gummy little hands around some of this stuff. So I think there's going to be higher taxes potentially nationalization, jurisdictional risk up the yin yang, and I can't tell you which jurisdictional risk is the worst. If you're in America, I would probably guess that the American jurisdiction is your biggest threat. We've seen it with sanctions against Russia, and they literally just froze assets, took assets, and I was impacted by that as well. And that could happen with any country. America did that to Americans, not Russia. They put sanctions on Russia. We didn't. It wasn't Russia taking our assets away from us. So the jurisdictional risk, in my opinion, the worst would be America, because I live in America. And I think I will be impacted by American sanctions and jurisdictions and tariffs and whatever else they want to do the most. That's what's going to hurt me the most. Here's Buffett. You don't need a lot of brains in this business. What you do need is emotional stability. You have to be able to think independently. When you come to a conclusion, you have to really not care what other people say and just follow the facts and your own reasoning. A lot of people, I think, struggle with this. They read an article. Oh, what about this article? What about this? What about this opinion? This person. Guys, you can't invest off of a consensus. Consensus doesn't work. What you need to do is you need to come down and create an opinion, and that opinion has to be right. That's how you make money. It doesn't matter what the consensus is. It doesn't matter what other people think. The best entry points is where no one is in consensus. So that's where you have to think independently. You can't read analysis from people who do analysis work. You can't listen to others. You can't listen to people on Twitter and gauge sentiment. I mean, you can gauge sentiment, but you have to take the opposite stance. I've been posting for a few years. It's happened. We are now there. You're being played. Fear and division. Plausible deniability and distraction. I hope enough of you can see it. But this is the 10-year yield minus the 2-year yield, and the yield curve inversion chart. Over 2 years inverted, and it's uninverting right in front of our eyes. Now, a lot of people are going to say, well, that's when we get a crisis. That's when we get a recession or a slowdown. And then he's got the recession, bolded out there. The question I have is it going to be inflationary or not? I think it's going to be inflationary. So I don't know. It's tough to call recessions, but the alignment is there for the 2 and the 10 yield curve. But there's some other things that you need to look at of how people are positioning in the market, which I'll show below. U.S. crude oil production has peaked and is going into decline if more rigs aren't added per TGS. There's some fracking people too, some companies that also think that we will go into decline in 2026. Maybe not 2025. There's some momentum, but with the frac crews being pulled back, and the bottom in fracking probably in 2025 here, quarter 3, quarter 4, we'll probably see a decline in production, U.S. crude oil production. Now, crude oil production, that's also got natural gas in it now, a whole bunch of nat gas. Market Sniper, in gold ounces, the 1929 high took 30 years to recover. The 1966 high took 32 years to recover. The 1999 high will be unlikely to recover in even 50 plus years for the Dow Jones Industrial Average priced in gold. All other equity crises were relatively insignificant in gold ounces and were just part of a far larger cycle ups and downs. Yup, that includes the massive events of 2020, 2008, 87, 73, and 1907. This illustrates that the creation of the Fed, 1913, has created all of the volatility rather than brought stability. This was the volatility before, big volatility swings of the boom bust cycles. And we have it going down where gold's going to outperform the Dow Jones Industrial Average. Gold stocks are ripping. Still think energy isn't about to join the party. Dow Jones Coal Stock Index breaking higher out of resistance, like we haven't noticed. This is wave one. This is a wave two pullback here. It's an A, B, C correction. And now we are breaking that into wave three. And coal stocks are absolutely ripping it. Dow Jones coal stocks versus the S&P 500 killing it. Breakout. And we positioned for it. We've positioned for that this breakout and captured it from this bottom right here. We purchased this entire bottom here on the website. We purchased this bottom, captured that move. We purchased the bottom in lithium, capturing that move. And we are now looking at the bottom of other markets currently right now, but no one's talking about them. I don't even talk about some of the markets that we are looking at right now on here Twitter because I don't even see anybody talking about it. And I don't want to post it. I don't want to post what I think will be some of the best sectors right now that are bottoming and give it away. I don't want to give it away. Nickel, well, this is one sector I think looks good. Nickel, the quiet setup. All eyes are on precious metals. It's understandable. Gold and silver just had their best 2-year runs in decades. But to win big in commodities, you need to target what's ignored. First in my series of Forgotten Ones, we'll cover how to play it and the key nickel equities. So this is what's coming up. We've got a 3-hump consolidation and it's in the dead period. This looks fantastic. And we are positioned already in nickel. This is the opportunity here, one of them. There's some other ones too. Dow equals Dow gold equals 1. We see all silver 45-year cup and handles, but who is looking at this perfectly valid horizontal channel? Exit the channel, and the top move is double the range to $1,800 in silver. Am I crazy? Some are calling for $18,000 gold. Others are calling for a 10-to-1 gold to silver ratio. And nobody bats an eye. So there is, I just like this pattern here. It's beautiful. We hit resistance, and now we're about to break out of that resistance and probably run. Beautiful looking pattern. Now, is $1,800 where we're going to go in silver? I don't know. I'm positioned for it. You know, a lot of people, they focus too much on price targets. They focus too much. Just think, what I look at is how big's this pattern and is it going to break out? Do the market conditions exist for this to go up in? And right now we have a gigantic pattern. It's going to break higher and the market conditions exist for silver to go up. That's what I want to use to position in. Your best positions are when you get in early, but you have to wait a little bit. So a lot of people will say, oh, that's not ready to go up. Baloney. You want to get in when it's the lowest risk, highest reward opportunity. Even if you have to wait a year or two, it's not a big deal because the moves are going to be so big. So you want to get in when people aren't looking and you've got the best risk reward. And that for silver, I mean, $18, that was just, it was like picking up $100 bills off the floor. It's easy money. Now it's getting harder because as the price goes up, you can get big pullbacks and you're starting to go above the cost curves. So bottoms of markets occur underneath the higher cost producers of the cost curve. And whenever you can buy underneath the highest cost producers of the cost curve at that time, you almost always end up making money so long that you buy the physical metal. It's almost guaranteed if you can wait long enough. And the physical metal, you carry no risk. There's no risk. You're not going to go bankrupt. Oh, I bankrupted physical silver. No, that's not how it works, guys. So I got my physical when it was underneath the cost curve. I bought a whole bunch. I like platinum too. That was underneath the cost curve. I mean, this is like cherry picking. And all you had to do was wait. People, oh, it didn't go up in a year or two. Oh my God. Just slap them in the face. That's so dumb. What, you're not going to wait for a 10 bagger? You're not going to wait for a 20 bagger? Tell me a better risk reward opportunity than platinum and silver at their bottom here. In 2018, it was silver. In 2020, it was also silver. In 2018, 19, and 2020, platinum was underneath its cost curve. The producers were cutting back their high cost mines. Tell me a better opportunity anywhere in the market at that time than those two things. Tell me what has better risk reward. Tell me what has more upside with literally zero risk. Tell me what's out there. I'm not going to go buy Nvidia that's overpriced. I'm not going to go buy overpriced stuff. Risk reward, there was nothing that was going to beat this. Now go look at history. Go look at history. Go look at like 1970 to 1980. Go look at 1940s, the price of silver, which is down here, all the way up. It was one big bull market. We are starting that big bull market from 2000 all the way upward. And we're going to break this big pattern here. There's nothing out there that's better. Silver breaking out against the consumer price index. I think that's where I ended last time. Yeah. So that's all I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like, especially with the coupon code. We've got a Sunday question and answer session going on today, 5 p.m. Mountain Time. You can ask me whatever you like. Doesn't matter. You can ask me anything, and I will answer it with my opinion there. All right, guys, that's all I've got. So we'll catch you next time. See ya.